Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB as we wrap up the day and the week on this Friday afternoon. I'm Andrew Gagan. Thanks for joining us. So, that widening Middle East conflict pushing oil back above $100 a barrel. That's weighed on global investor sentiment, and that's bled into our own index here. In fact, the S&P ASX 200, it is off around 0.9%. In fact, looking now, it's currently off by 0.8%. Bit of a comeback there just over the last hour or two. Similar moves there on the CBO 200. In fact, on the ASX, we've lost about 0.33% for the week, and we're back to where we began at the beginning of the year. Now, adding to the negativity, concerns over AI spending that spooked Wall Street, of course, and that has hit the local tech sector. And also, we've had that news that the Trump administration is slapping a 12.5% tariff on Aussie imports, accusing Australia of inadequately enforcing ban on goods produced by forced labour. So that gets to our themes of the day. Tariff top up, I should say, given that news. Many countries hit with a 10% tariff, but oddly enough, Australia in that basket of 12.5%. Cochlear, well, that refers to Cochlear. In fact, it's escaped those tariffs. It's going to import goods into the States duty-free, and oil overdrive, goodness, back above $100 a barrel. Obviously, the big concern of the inflationary effects that's going to have. Ahead of the RBA next meeting, it's coming. We do get that read on inflation next week. Let's catch up with the sectors of the day, those that have moved. I mentioned their tech. Obviously, those concerns on Wall Street about vast capex that's been thrown around at the moment and whether you're going to see returns there. And that has affected the local tech sector. WiseTech down almost 5% today, Zero a similar amount. The miners, well, they did no digging today. In fact, they have headed lower. BHP off more than 2.5%, but it was actually the goldies that have felt most of the pain there, given gold took another tumble overnight, whereas energy has headed high. No surprise there, given where oil prices are going, not just in terms of oil and gas, but also those uranium producers doing well. Let's get to the top stories of the day then. And Cochlear can now import its hearing implants into the US duty-free after a government investigation removed the risk of tariffs in its biggest market. In the gold space, Newmont reporting 1.29 million ounces of gold production in the second quarter, which with a record free cash flow of 2.2 billion, remains on track for production guidance of 5.3 million ounces for the financial year, but obviously that was dragged lower by the broader negativity in the gold sector. The ASX, the CFO Andrew Tobin, I should say, will retire, with incoming CEO Anthony Attia to lead the search for his replacement. And in New Zealand, Chorus, fibre connections rose to 1.14 million at the end of June, with around a 76% uptake and fewer than 1,000 copper connections left to migrate. And back in the gold sector, Regis Resources reinstating its McPhillamys Gold Project Ore Reserve, with that valued at 1.13 billion post-tax. Well, let's get across what is moving in the markets. Plenty, it would seem. A lot of news to get across. Much of it negative, of course. Let's catch up with Shane Oliver from AMP. Shane, happy Friday to you. Look, the hits keep coming. We've got rising oil prices, the likely inflationary effects, what that means for interest rates, and tariffs on top of that. My goodness, we'll get to that in just a moment. I was interesting to see, in fact, I caught up with your note, and you had that chart of bond yields. Like the US 10-year, 18-month highs. What are we seeing there? What is actually moving those yields higher, just in terms of, is it the rising oil price, or is it the vast amount of borrowing that those AI companies are doing, particularly on Wall Street, or is it perhaps a combination?
I think, to be honest with you, it's a combination. You are seeing a lot of borrowing now, which of course, it goes out as corporate debt, but they're still competing with the public sector, and that. Then, of course, we've seen the resumption of the war, the re-escalation there, the surge in the oil prices, the heightened expectations for inflation and central bank rate hikes, so they're all pushing it higher. But you can see there, when you look at that chart there, it looks like there was a huge downtrend into 2020, 2021. And that had been going on for, decades. Go back to the 1980s and 1990s when bond yields peaked at double-digit levels. So we had that massive downswing over multiple decades, period of disinflation. Now we seem to be going into an era of higher inflation and more borrowing. And it's interesting to note, remember that panic around Liz Truss, was it September, October 2022, almost 4 years ago now. We look at the red line there, which one's the UK? It's one of those lines anyway, towards the top. The
yellow
one,
yes,
think it is,
yep.
the UK.
Yeah.
That's at higher levels than it was when Liz Truss was briefly PM. And we've obviously got a new PM taking over in the UK, and he's perhaps more inclined to borrow than maybe she was. So all of these things are playing a role in pushing bond yields higher, but they do come with concerns, because higher bond yields will pressure share market valuations. It's going to mean increasing borrowing costs for governments. Public debt interest is the fastest growing component in the federal budget spending item. That's what they're spending on, increasingly on that. There was an estimate earlier in the week that $1 in each $10 of revenue raised in Victoria would go towards paying off or interest costs on public debt. So there is pressure from this, and of course that in turn puts more pressure on those budget deficits, because you're effectively borrowing to pay debt on past borrowings. So it's not a great situation, but for ordinary Australians it can mean higher fixed rate mortgage costs as well. It doesn't necessarily mean higher variable rates, may reflect expectations for that, but it can mean, if it's sustained, another round of fixed rate mortgage rate increases in the months or weeks ahead.
Well, which takes us to perhaps potentially what the RBA is going to be forced to do, Shane. Given what's going on with oil at the moment and the likely inflationary effects, with Australia obviously already dealing with an inflation problem, let's just first take a look at, though, what's going on with oil and its movement in the Middle East. In fact, I think we've got a map we can bring up, which once again has come from your note. Now, obviously, the focus has been on the Strait of Hormuz, but the Houthis have opened up another front there, perhaps appropriately called it the Gate of Tears.
That's right. That's one down there, bottom, just off to the left a little bit, Strait of Bab el, or El, depending on how you pronounce it, Mandeb, comes out of the Red Sea. So a lot of the oil, which had been going through the Strait of Hormuz from Saudi Arabia, they've been able to divert up to 7 million barrels per day across that east-west pipeline that you see on the chart there. Now, there is a dotted line going up to the, the northwest, and out through, I think, Israel, but that one's not operational for obvious reasons, given the wars around that region, Iraq and other parts of the world, Syria and so on. So that doesn't work. So they've only got the firm one, which goes across the country to the Red Sea. Now, that's been good. They've been able to divert some of the oil that would have otherwise had to come through the Strait of Hormuz, and therefore the hit to global oil supplies has not been as great as the 20% that people talked about, including me, back in March, because of that diversion. It's only been maybe 12 million barrels as opposed to 20 million barrels. And the UAE, United Arab Emirates, also have a pipeline in green there again, going across to Fujairah. Hopefully I pronounced that as well. So those diversions help. But if the Houthis are able to disrupt Saudi Arabia putting oil out through the Strait of Bab el-Mandeb, and the Houthis are down just above that in Yemen, western Yemen, then that will be a problem. Now, in theory, the big oil tankers can head north to the Suez Canal. They can't actually get through the Suez Canal, so they've got to offload it into a pipeline which apparently tracks alongside the Suez Canal and then pops out on the other side in the Mediterranean, so other ships can collect it and then bring it to Asia. But the problem with that is that there's an extra travel time, obviously, because you've got to go around Africa to do all of that, a lot more mucking around, so to speak. So that adds to costs. So obviously, if the Houthis continue to disrupt things, then that is a major problem. And then that in turn accelerates the time when the global economy starts to scrape the bottom of the barrel in terms of global oil reserves, and therefore that we may have to actually learn to live with a 15-20% reduction in global oil supplies. Now, we haven't had to do that so far because we've been running on reserves. stockpiles that have been built up around the world. But as those stockpiles get run down, we could potentially face an issue. And that, I think, is what the oil market is starting to grapple with, and what share markets, to a lesser degree, are starting to focus on.
Well, all of which, of course, is not good news, particularly for the Aussie consumer, not just higher fuel prices. That's going to flow in through prices across the economy. And Shane, it comes as we consider what the RBA is going to be forced to do next. Obviously, we got that much higher than expected jobs figure yesterday. Next week, we get that quarterly read on inflation. What are your expectations? What is the RBA going to have to do from here, do you think?
Well, the key will be the trim mean rate of inflation, which we expect on a monthly basis to jump up to, I think, 3.7%, and on a quarterly basis to jump up to 3.8%. So the previous readings for May were 3.6% on a monthly basis, and the last quarterly for the quarter of the March quarter was 3.5%. So we expect a further acceleration in underlying inflation. The headline inflation will bounce around a bit. It's probably still stuck around 4%. We've got lower fuel prices, but we're seeing increased prices for new dwelling costs, rents, health, and of course travel costs. School holidays again will push that up a little bit. So all of those things are impacting, but I think if you do get a quarterly around 3.8% on trim mean, that's the underlying rate of inflation. For those watching this, that's not higher petrol prices. It may be the indirect of higher fuel prices, but the RBA is not jumping at shadows caused by volatility in fuel prices any more than it jumps at shadows caused by volatility in fruit and vegetable prices due to floods and bad weather. They will focus on the underlying rate, and it's going the wrong way. That 3.8% is what they forecast back in May. But back in May, just bear in mind, they were assuming another hike. The money markets were factoring in another hike at the time, and they took that on board in their forecasts. So we think if we do get another 3.8%, we do get 3.8% in the quarterly trim mean, then it will clear the way for the RBA to probably hike at its meeting in a few weeks' time. I mean, it's not dead cert. The RBA might say, well, let's wait and see the impact on the economy from this ongoing situation in the Middle East. The jobs figures were strong, but there are signs of rising underemployment. So let's wait a little bit longer. So that could happen, but I think that would probably be a bit of a mistake.
And Shane, just briefly, the Trump administration, 12.5% tariff on imports from Australia. Look, this is all in regards to, well, that we're not doing enough to stop forced labour. I mean, how spurious are those claims, and why is Australia copying it? Like other economies such as Britain, they've got 10%.
Well, I think it's bonkers. It's just a joke. For some reason, I've just sat here and the sun's just moved and suddenly I've got sun on half my head and not on the other half. But anyway, I have to live with that. But it's perverse. I mean, the Trump administration had to scrape around and make up another reason to put some tariffs on, and they come up with this idea about forced labour, and they've accused virtually the whole of the rest of the world using or getting the benefit of forced labour. We can see all the slaves working in Australia, perhaps. I can't see them, but maybe Trump sees them. So that I think strikes me as ridiculous. And the funny thing is, if you're not doing anything about it, you pay 12.5%. If you are doing something about it, well, you get a 10% tariff anyway. So it's just totally laughable. So anyway, that's the logic. It's no more logical than Trump getting upset at the smoke blowing across cities in the north of the US from Canada, and maybe inhaled too much of that smoke and decided to put another tariff on Canada in the last week. I can't explain that one either. But anyway, back to the situation in Australia. I don't think it's quite as bad as it looks. On the one hand, yes, we're going from 10 to 12.5, but a lot of our goods are exempt anyway. I think that includes gold, beef, plasma products, which dominate pharmaceuticals, copper. So a lot of the things we do send to the US are exempt from a tariff anyway because of industry exemptions. So it's not as bad as it looks. The other thing is that many of those countries on 10% forced labour tariff will soon jump up to another new tariff that Trump will make up in relation to excess capacity. And that will include countries like China and most of Europe, or all of Europe. So, yes, we've lost a bit of our advantage. We're no longer at the bottom end of the range. We're at the at 12.5% at the higher end, but I think a lot of those countries on 10% will pay higher tariffs down the track. So it's a messy situation. I find it very difficult to explain it. It just highlights the mess that Trump is creating globally, and that is coming with a cost in terms of higher costs of living, not just for Americans, but also impacting Australians, obviously with energy prices, but also a risk to economic growth.
Well, much like the sun is casting a shadow across your face, Donald Trump casting a shadow across the global economy. Shane.
It is a bit like that.
Thanks for joining us. Have a great weekend. Thanks for joining us.
Thanks, Andrew. You too.
All right, let's get to our stock of the day in relation to tariffs. In particular, was Cochlear, the hearing implant maker, saying it can now import its products into the US duty-free. To get across what they think of the stock, we caught up with Junbei Liu from TenCap and Adam Dawes from Shaw & Partners.
I'll put this on a hold. If you've got it, look, it's a fantastic business, a great success story. We do love it. But I wouldn't be selling it, but I think it is one positive step in the right direction for Cochlear with this announcement today.
Yeah, look, I probably put on the hold as well. There you go, Adam.
Hey.
We're starting off strong. Look, I think it's, look, on 12, it depends on your time horizon, right? On 12-month view, I think it's a very easy buy. I'd step out and buy it today. But the problem is, at the moment, the company is we're heading into Australian reporting season. Now, Cochlear is very likely to downgrade next year's earning. Consensus sitting at 10%. They're not going to do that. Company's going to guide smaller than that. Might be just a few percent, might be 5%, but we all know what happens to expensive companies when they disappoint analyst expectations. So I'll be putting a buy on the result when they do give a more realistic guidance.
All right, let's catch up with the best and worst in today's trade then, beginning with what's in the green. No surprise, energy stocks led by crude up 11%. Treasury Wine Estate also moving higher today. Defence stocks are still among them. And those that have fallen very much in the gold space, and also lithium miners coming under pressure today as well. Now, overnight, we get US and UK S&P Global Manufacturing and Services PMIs. More commentary from the ECB in the wake of their decision to leave rates on hold. And US earnings continue, of course. ExxonMobil, American Express, NextEra, and Verizon reporting tonight. Next week, overseas at least, the Fed interest rate decision, the Bank of England rate decision as well, core PCE price data out of the States, an OPEC meeting, that'll be interesting, of course. And locally, that all-important quarterly read on inflation. That comes Wednesday. All right, let's recap then where we're finishing this Friday and the week. We are more than 0.8% lower on the CBO 200, on the S&P ASX 200, 0.75% lower, to be down around 0.25% for the week and back to where we were at the beginning of the year. That is the COB. Thanks for watching and listening.